You deposit $1,000 into your bank account. Most people believe their money stays safely inside the bank. But banks don't work like giant safes. Banks are designed to keep money moving. Every deposit begins a financial journey. Your money doesn't stay in one place. It begins circulating through the economy. This movement is what banks depend on. Money that sits still earns almost nothing. Money that moves creates profit. Let's build a bank from scratch. Without deposits, a bank cannot lend. Deposits are the fuel of banking. Now you deposit $1,000. The bank can finally start doing business. But the bank won't lend every dollar. Some money must always remain available. The rest is put to work. This is where the real business begins. To understand how banks make money, you first have to understand how money moves. But before a bank can make money, it first needs your money. Think of deposits as the bank's fuel. No fuel, no business. So here's a question. Why would anyone leave money in a bank instead of keeping it at home? For one reason, trust. People believe they can get their money back whenever they need it. That trust is worth more than the building itself. Without trust, people stop depositing money. And without deposits, banks stop making new loans. That's why every bank competes for deposits. Because deposits are their raw material. Without deposits, there is no banking business. But here's something strange. Banks actually pay you for your deposits. Why would a business pay for something it already receives? Because deposits are not free. To a bank, your deposit is actually a liability. That sounds backwards, doesn't it? Most people think deposits are the bank's money. But legally, the bank owes that money back to you. That promise is recorded as a liability. Here's a quick challenge. If deposits are liabilities, then what counts as the bank's asset? The answer is loans. Every loan is money the bank expects to get back. Hopefully, with interest. That's the heart of banking. Borrow low, lend higher. The difference becomes profit. But in the real world, it's a little more complicated than that. Let's open the bank's books. Every bank keeps a balance sheet. This document shows everything the bank owns and everything the bank owes. Think of it like a giant financial scoreboard. If the two sides don't balance, something is wrong. Here's another challenge. Can you guess which one earns the bank money? Let's find out. The bank's biggest asset isn't cash. It's the promises people make to repay their loans. Every monthly payment brings money back to the bank. And every payment includes two parts. Can you guess which part becomes the bank's income? The principal simply pays back the money that was borrowed. Interest is the price of borrowing that money. That extra amount is one of the bank's main sources of revenue. But here's another question. What happens if someone never pays the loan back? The biggest threat to any bank isn't low profits. It's borrowers who stop paying. Banks call this a default. A default doesn't just reduce profit. It can destroy the original loan itself. Imagine lending $100,000 for a home. For years, everything goes exactly as planned. Then suddenly, the payments stop. Now ask yourself, what should the bank do next? The bank can't simply hope the borrower starts paying again. It needs a backup plan. That's why many loans require collateral. Collateral is something valuable the borrower promises to the bank. A house is one of the most common forms of collateral. Now here's another question. Does the bank want your house? Or does it want its money back? The answer surprises many people. Banks don't want your house. They want successful loans that are repaid with interest. If banks don't want your house, why do they ask for collateral? Because banks prepare for the worst. Every loan carries risk. Some borrowers lose their jobs. Some businesses fail. Some people simply stop paying. Banks can't predict exactly who will default, so they estimate the probability instead. This process is called credit risk analysis. But how does a bank measure risk? It starts by checking your income, then your existing debts, then your repayment history, then the value of your collateral. Every piece of information changes the bank's decision. Even a small change can affect your interest rate. Lower risk usually means lower interest. Higher risk usually means higher interest. Banks aren't trying to punish risky borrowers. They're trying to price the risk accurately. Imagine two people applying for the exact same loan. They both want to borrow $100,000, but one receives a much lower interest rate. Why? The answer isn't fairness. It's probability. Banks estimate the chance that you'll repay the loan. The higher the risk, the higher the interest rate. Higher interest helps cover higher risk. Now think about this. Would you lend money to a complete stranger? Probably not. You want more information first. Banks think exactly the same way. The only difference: banks analyze millions of loans. They learn from decades of repayment data. Every new loan improves future decisions. That's why modern banking is built on data as much as money. But here's where banking becomes truly fascinating. Most people believe banks simply lend out the money you deposit. That sounds logical, but modern banking works differently. Much differently. Imagine you qualify for a $100,000 mortgage. Here's the surprising part. The bank doesn't hand you a suitcase full of cash. Instead, the bank credits your account with a new deposit. No truck delivers cash. No vault suddenly becomes empty. The money appears as a bank deposit. This is why economists say banks create money through lending. Not by printing cash, but by creating new bank deposits. Pause for a second. Did that surprise you? Because almost nobody learns this in school. And it's one of the most important ideas in modern economics. But wait a minute. If banks create money through lending, why don't they create unlimited money? That's a great question, because banks face several powerful limits. The first limit is capital. Capital is the bank's own money, not its customers' money. Think of capital as the bank's safety cushion. If too many loans fail, those losses are absorbed by capital first. Now imagine the losses keep growing. Eventually, the cushion becomes too small. That's why regulators require minimum capital levels. The bigger the risks, the more capital a bank must hold. So banks can't expand forever. Their own capital eventually becomes the bottleneck. And that's only the first limit. The next one is even more interesting, because creating money is easy, but settling payments is not. Imagine you borrow $100,000 from Bank A. The money appears in your account instantly. Now you buy a house, but the seller uses a different bank. So the money has to move from Bank A to Bank B. Here's the catch. Banks don't settle payments using customer deposits. They settle using reserves held at the central bank. Think of reserves as money that only banks can use. You can never spend reserves, but your bank does every day. Now another important question. What happens if bank A doesn't have enough reserves? Does the payment fail? Not necessarily. Banks can borrow reserves from other banks. This happens every single day. Banks are constantly lending to each other. This is called the interbank market. Without it, the entire payment system would slow down. The banking system doesn't work because banks have unlimited money. It works because banks settle millions of payments by moving reserves every day. But who creates bank reserves? Not commercial banks. Only the central bank can create reserves. Think of reserves as the banking system's private money. You use deposits. Banks use reserves. They're two different types of money, and confusing them causes a lot of misunderstandings. Here's another question. If banks need reserves, why doesn't the central bank give them unlimited reserves? Because too much money can fuel inflation. When money grows much faster than production, more money ends up chasing the same goods. That's one reason prices can rise. So the central bank has another job: keeping inflation under control without slowing the economy too much. It's one of the hardest balancing acts in economics. And it's why every interest rate decision matters to millions of people. Let's put everything together. People save money in banks. Banks make loans to households and businesses. Those loans help build homes, start companies, and create jobs. Successful borrowers repay their loans with interest. That interest pays employees, covers operating costs, and rewards shareholders for taking risk. But every loan also carries the possibility of loss. That's why banks spend so much time measuring risk. Good banking isn't about making the biggest loan. It's about making loans that are likely to be repaid. That's what keeps the banking system stable. And that's why banks exist. Not to store money, but to move money where it creates the most value. Now, when someone says banks just keep your money safe, you'll know there's a much deeper story behind every deposit, every loan, and every payment. But if banks are so carefully designed, why do banks sometimes collapse? The answer isn't always bad loans. Sometimes the problem is fear. Imagine hearing a rumor that your bank is in trouble. What would you do? Would you leave your money there? Or would you withdraw it immediately? Most people choose to withdraw, and that's where the real problem begins. Banks don't keep everyone's deposits as cash. Most of that money has already been lent out. Those loans can't be collected overnight. So even a healthy bank can face a cash shortage. This is called a bank run. A bank run is a liquidity crisis, not necessarily a solvency crisis. In other words, the bank may own valuable assets, but it doesn't have enough cash available today. That's why confidence is one of the most valuable assets any bank can have. So how do governments stop bank runs? The first tool is deposit insurance. It protects ordinary depositors. If the bank fails, insured deposits are usually repaid. That gives people less reason to panic. But what if the bank suddenly runs out of cash? That's where the central bank steps in. It can lend reserves to healthy banks facing temporary liquidity problems. Economists call this the lender of last resort. Notice something important. The central bank isn't rescuing every bad decision. Its goal is to keep the payment system working, because millions of salaries depend on it. So do pensions. So do businesses paying suppliers. A broken payment system can quickly affect the entire economy. That's why financial stability matters so much. Without trust, even a healthy banking system can face a crisis. So how does the central bank slow inflation? Its most powerful tool is the interest rate. When the central bank raises interest rates, borrowing becomes more expensive. Some families delay buying a house. Some businesses delay expanding. That means fewer new loans and slower growth in bank-created money. Demand across the economy begins to cool. That can reduce inflation over time. Now, let's look at the opposite situation. Suppose the economy falls into a recession. Businesses stop investing. Consumers spend less. Unemployment begins to rise. The central bank may lower interest rates. Lower borrowing costs encourage new loans. New loans create new deposits. More spending can help the economy recover. That's why one small interest rate decision can influence millions of people around the world. Now, imagine something unusual happens. Banks suddenly stop making new loans. Not because they ran out of money, but because they're afraid of taking more risk. What happens next? Families struggle to buy homes. Businesses cancel expansion plans. Entrepreneurs delay starting new companies. Consumers reduce spending. The economy begins to slow. Now, something even more interesting happens. Remember how banks create deposits when they make loans? If fewer loans are created, fewer new deposits are created too. Credit growth begins to slow. Money moves through the economy more slowly. Companies earn less revenue. Some businesses reduce hiring. Others cut jobs entirely. That's why economists closely watch bank lending. It often reveals where the economy may be heading next. After everything we've learned, one myth still refuses to disappear. Banks don't simply store your money. They connect people who save with people who need capital to build the future. Every mortgage, every business loan, and every payment tells part of that story. The banking system isn't perfect, but without it, the modern economy couldn't function the way it does today. So the next time you transfer money, pay your mortgage, or receive your salary, remember that thousands of banks, millions of loans, and trillions of dollars are working together behind the scenes. It's one of the most complex systems humans have ever built. And now, you understand how banks actually make money. If you learned something new today, subscribe for more deep dives into finance and economics. Because the more you understand money, the better decisions you'll make with it. The next time you check your bank balance, remember you're looking at one small part of a system that keeps the entire economy moving. We break down the hidden systems behind money, investing, finance, and economics into simple visuals. If you enjoyed this video, subscribe to learn something new with every episode. Thanks for watching, and I'll see you in the next one.